Now, some of Europe's biggest banks are planning to return some of the money that they borrowed from the European Central Bank's easy financing operation. These banks include Italy's UniCredit, France's BNP Paribas and Societe Generale, and La Caixa in Spain. These banks will return around 80 billion euros over the next 12 months. The long-term refinancing operation, or the LTRO, flooded the European banking system with something like 1 trillion euros at an extremely cheap interest rate of just 1%. The money is repayable in December 2014 and February 2015, but banks are allowed to return the money within the first 12 months. All right, for more on the situation in the Eurozone, we've got Christian Schulz, who's a senior economist at Berenberg Bank, who joins us on the show from London. Now, Christian, to begin with, some of the bigger banks in the EU are preparing to pay back at least about a tenth of all the money lent by the ECB under the LTRO as early as March of next year. Now, while the money may have initially helped stabilize the markets, would you say that banks looking to return this money is somewhere indicative of a reluctance to take on risk by on-lending this money to the real sector?
Well, it's certainly some sort of re-stigmatization of using the ECB facilities. It is a positive sign that some banks, or most banks even, seem to be confident that they don't need all that money that they borrowed from the ECB, the whole 1 trillion. So in that sense, it's positive that banks are preparing to repay that money, and in fact, in 3 years' time, they will have to probably repay the full amount, and the ECB could be slightly worried whether the financial sector is preparing. So it's a bit of good news, but that stigmatization that goes along with some healthier banks announcing that they're repaying, while some maybe not so healthy banks will continue to stay on the ECB money and be reliant on that for funding, is a bit of a negative, because it just means that we will quickly know which banks have more trouble than other banks, and that could once again lead to sell-offs in certain banking sectors of the banking industry in Europe, and that would be a negative for some countries especially.